is Bazaar Morning Call, live from the CNBC-TV18 headquarters in Mumbai.
Concerns about a China trade deal reverberating through this market for a second day in a row.
Tariffs were supposed to go into effect months ago. So he actually has been very cautious.
The prospects of tariffs, new tariffs for months on end, lowers global growth prospects in general.
The markets will feel it because the average S&P company is outwardly oriented.
We're down 1.7% on the S&P, 480 points on the Dow.
Good morning. That was nothing to clap about. A huge fall both in the Wall Street indices and followed up by big falls in the Asian indices as well. Good morning, everybody. We hope it is a good morning. The story is, I think, by now familiar, but President Trump had tweeted over the weekend that if there is no deal, he expects by Friday that tariffs on $200 billion of goods will go up from 10% to 25%. The market thought it was another of his negotiating tactics and took it lightly. But it was reiterated yesterday by the U.S. Trade Representative Robert Lighthizer, when he said that U.S. will increase tariffs. The markets were, of course, hoping that the fact that the Chinese vice premier is coming is probably good news, but Lighthizer's comments took the markets down. It simply means that probably the US means business. There will be many, of course, in the market, because if the tariffs do come, then even 470 down is not enough. So even now, there are a lot of people in the market, all Asian as well as US, who believe that a deal will come because it can be extremely destructive. First, of course, US consumer goods themselves would be affected. So hopefully there will still be a deal. I guess if it's a question of a global growth slowdown, there is no way India will escape with that kind of sell-off. We have seen the FII selling over the last few days, so we will be affected. Now the story is, did we presage the fall already that the US saw, and therefore is much of the damage already done for us? But then we must remember that we also have our own worries. This worry over pledged share promoters and NBFCs again came into play yesterday. We saw the DHFLs and the SL Group stocks, among others, taking a beating. So let's remember that we have our own small coterie of problems. Today, of course, the SL Group has come with a very serious statement, emphatic statement that a deal is in advanced stages. That will probably assuage markets, but we have to worry about that. A small sucker in all this, crude is back at 70.
Okay. Lata, hi, morning. Anuj, morning. And of course, the earnings downgrades still continue, right? Among the consumption piece. So Escorts, for example, has seen a slew of downgrades come in post numbers. But coming back to the FI data, it's been 3 straight days now that FIs have sold in the market. In fact, yesterday, if you look at it, 645 crores of selling is what you saw. The standout feature is that a lot of profit booking is seen in the large cap gainers. So if you look at the 3 stocks that saw large delivery based selling yesterday, ICICI Bank, Reliance Industries, HDFC Bank, also about 300 to 600 crores of delivery selling. The one common feature is that these are stocks that rallied a lot over the last couple of months or so, 6 months rather. So perhaps there's some money being taken off the table by FIIs ahead of the big event, which is the elections. Of course, the Nifty also ended in the red for the 5th straight day. So what should we be doing now? Anuj, morning. How does the risk reward look now to go short in this market? I mean, is it too late? Was yesterday a better day than today?
Oh, yesterday definitely, good morning, was definitely a better day. But you know what, if Liverpool can beat Barcelona 4-0, then anything is possible in the market. It makes you believe. But look, Sonia, the point here is most money in market is made when you believe your conviction and try to go anti-consensus at times. Like yesterday, ICICI Bank, for example, that would have been the trade that would have made you a lot of money. When everyone was long, if you had taken a short trade, you would have made money. I'm not saying that this morning you straight away try a long trade, but look at the stats this morning. And while, I know a lot of people talking about politics as a factor, it's all global. Just look at the indices, the MSCI Asia ex Japan, MSCI Emerging Market, MSCI India. This is this week and this month. It's absolutely in line, 2.2 to 2.5% for all markets, both this week and this month. So yes, let's see how things move. Anecdotally, I've found that if the markets fall because of the trade worries, that has been the best buying opportunity, because it never works out like that. It's a lose-lose game. There's a lot of posturing. Also, let's remember that Donald Trump, while he is the president of the United States, is also a very successful businessman and very successful negotiator. So I give a lot of importance to anecdotes, and anecdotes tell me that this would be a buying opportunity. However, not necessarily that straight away you buy every dip and it works. Yesterday's last hour fall, like we discussed in closing bell, was purely on account of stop losses getting triggered. Everyone had kept 11,550 as a stop loss on Nifty and 29,500 on the Bank Nifty. Those were the two lines in sand. Once they were breached, the market fell under its own weight. Typically, you try, like I also mentioned, you also mentioned, we sort of sometimes preempt the global fall. The only problem is, if this fall is going to be protracted over, say, 2 or 3 weeks. That's something that we'll find out. But this morning, the risk reward will not favor a fresh short if we open 60-point gap down, because we already fell about 100 points previous day and 100 point yesterday. After that, to sell, I don't think will favor a short trade. FIs have taken a large amount of short positions. It's possible that at any point they might want to cover, because and that covering could be, now the market has shorts in system. It will need some trigger. I don't know where the trigger will come, whether the market latches onto crude or perhaps some kind of unofficial exit poll or whatever, but it needs some kind of trigger to perhaps bounce back. But for whatever it's worth, if you are a long trader or want to take a long, where should you keep your stop losses? I think the next levels to watch, 11,350 on the Nifty, which is also corresponding to its 50-day moving average, and also the last sort of low for the market, and 29,050 on the Nifty Bank. The Nifty Bank is weaker of the two, but the problem with Nifty Bank is it will require just 1% move in HDFC Bank to change sentiment around. So to cut a long story short, risk reward does not favor a short. It doesn't mean that the market will stop falling, but if the market starts to give you any kind of reversal signal, I think the pullback could also be very interesting.
We were also discussing yesterday in closing bell as to how a lot of these large cap names are, seeing money being taken off. You think that would be the logical move ahead of a big trigger, which is the elections as well as this global risk aversion?
No, I think that's a very good point you made. And on that, look, the problem with this market before this whole ETF inflow started into our market was that we had a nice rally going for us. The last rally was unhealthy. That's the point. We remember making this point, how mid caps were falling, how broader market is capitulating. Broader market feels like 10,000. Forget about 11,500. It's the 4 or 5 stocks where the ETF money just kept chasing, and took the prices to crazy levels. And now, reverse of that is happening. That's the problem in the market. That's a double-edged sword that you have. That ETF money is essentially momentum chasing money. The moment the momentum stops, you start to withdraw the money, and that's what's happened. I think it will be healthy for the market if there's some more large cap correction to make sort of market, a bit healthy. Let the mid caps also catch up a bit. That will happen perhaps post-election. But yes, this is that ETF money which was chasing the market, which is now withdrawing, so it should not surprise anyone.
That part of the Indian market is entirely synced with Asian markets, as Anuja's first graph put out. It was foreign money coming in, but my sense is that there is separately a different drama playing out in the NBFC space. We had kind of tided over the October problems with most of the NBFCs selling off their good assets and finding a buyer. But now what is left is not a great deal of the good assets, and the banks are having their own business. So they are not in a mood to buy out NBFC stocks or NBFC portfolios. The NBFC's got 6 months to sort themselves out, but that's not enough, because the problem is very serious. So after all the good assets have been creamed off, now the worry is what happens to the remaining portfolios. Do they have any other trick in the bag to meet their ALM mismatches, to meet their assets? So that's a separate issue which the mid-cap index has to deal with. That's not part of the global chain.
Okay, well, we'll keep an eye out on all of these triggers. 2,000 crores of selling by FIs in just 3 trading sessions. That's quite a bit. So don't lose sight of that. Let's do one thing. Let's take a quick look at what our wise experts have to say as we head into trade this morning. First up, Gautam Dugat of Motilal Oswal says valuations at 19 times FY20 EPS for the Nifty do not provide any material cushion. They expect the rest of 2019 to be volatile, even after the government formation exercise is behind. Also, bottom-up stock picking will be crucial at a time like this. They like private banks given the bottoming out of asset quality stress and market share gains from NBFCs. Despite the recent downward revision in guidance by Cognizant, they like IT stocks due to its sustained healthy earnings growth, favorable deal activity and reasonable valuations. They remain selective in consumers and automobiles and prefer stocks with earnings visibility. Their top large cap bets include ICICI Bank, Titan, Maruti, Bharti Airtel, Infosys, Motherson Sumi, HUL, Coal India and SBI. Their top mid cap bets are Aditya Birla Fashion, Federal Bank, DCB, Godrej Agrovet, Indian Hotels, Zensar, Crompton Consumer and Tata Chemicals. That's pretty specific.
Yeah, and quite a long list for those who are fishing in troubled waters for longer term investments. Okay, that's why we kept that advice in great detail. Here are some money market views. Not much over there. Let's see if the rupee starts wilting today. It didn't wilt much yesterday. Pramit Brahmavata Veracity says the rupee will trade sideways to negative on the back of negative cues from the domestic equity market. Trading range for the spot USD INR pair could be between 69.20 to 69.60. My sense is 20 looks a long shot today. It's more likely to be south of 69.50. 69.50, 69.60 looks more likely.
Okay, Dhaval Dalal of Edelweiss also speaks about the bond markets. He says prospects of liquidity injection by the RBI in the near term has enthused bond market participants amidst the recent bout of nervousness in global equities, fall in crude prices and signs of global economic slowdown. This should also help contain recent widening of credit spreads of commercial paper issued by NBFCs and housing finance companies to some extent. They remain bullish on the 10-year bond and expected to trend towards 7.25% in the very medium term.
Okay, the big problem for the market this morning, of course, the global screen that's looking right across the board. Here's Nigel with the world view.
Well, no pullback this time around. In the previous trading session, the Dow had pulled back nearly around 400 points from the low point of the day. This time, no such luck. Ended with a cut of close to around 470 points. That's after, comments that did come in from Robert Lighthizer. He said that come Friday, they're going to go ahead and increase tariffs on Chinese imports. There was hope that the Chinese delegation is moving to the United States and they could, come to some sort of an understanding. But after those statements, it wasn't great news. All fell down. The 30 Dow components, all of them ended in the red. You have 11 S&P sectors, all of them as well, ended in the red in yesterday's trading session. And a couple of those stocks that are known as trade bellwethers, you had Caterpillar and Boeing. Remember, Boeing is the largest weight on the Dow. That, in fact, was down close to around 3%. Caterpillar as well was struggling, and Boeing broke its 200 EMA, so technically as well looking rather weak. Now, there is a fear that Chinese will go ahead and retaliate. If that happens, the street was fearing out there. So Apple was down nearly around 2% yesterday. Nvidia as well, the chip maker, that as well was down nearly around 3-4% odd. So clearly, there was a lot of selling across the board. Now, they had a note coming in from UBS. They said if these tariffs are put into play, then it could shave off nearly around 40 basis points in terms of global growth numbers. And in terms of the Chinese, it'll be more than 100 basis points. So that was a UBS note that did come in yesterday. In terms of the European markets, they as well fell in step. All the three frontliners were down anything between around 1% to around 1.5% odd. And some earnings reactions weren't great. So you had, a few of these banking names as well that were under pressure. All of them up for you on the screen. And the earnings as well didn't look very good. So BMW was down 4%. Beer maker AB InBev, that as well was struggling. And Allergen as well was down anything between 3 to around 4%. The dollar index continues to hold at around 97.5 odd. But the yen is strengthening, which is not good news for the Japanese market. So that is the underperformer today. That, in fact, was down close to around 1.5%. It's still holding with the cut. And Asian markets basically in a bit of a tizzy. The only positive is that Brent crude prices has corrected close to around $1 from yesterday's peak. The SGX Nifty, though, after correcting nearly around 200 points in the last couple of trading sessions, indicating we'll start off in the red with a cut of around 50 points approximately.
Thanks, Nigel. That last screen is always so important. You ended up with SGX Nifty. Today, at the moment, it's showing a bit of a bother, and therefore it's important to get some of the most learned opinion possible on the US trade war. One man who has been there, done that, seen it all, Mohammad El Arian of Alliance, spoke to CNBC on the US-China trade concerns. Let's just listen in to highlights of his conversation.
I think what we heard from President Trump is part of the negotiation process. It reflects that the U.S. has much more leverage than China and that China is going to have to make concessions. And I think that we do get a deal in the short term. Importantly is not whether we get a short-term deal, is that these tensions aren't going away. It's no longer just about economics. It's about economics and national security. So these tensions are going to come up over and over again. Everybody who's exporting to China has witnessed a significant slowdown. It's not just U.S. Look at South Korea's numbers, look at Taiwan's numbers. And I think that's the reality, that the Chinese economy has slowed significantly. It has lost the tailwind of the global economy. And I don't think that goes away. I think at best they're going to stabilize, but we're not going to see a bounce back to the higher growth that we've seen in the past. The things you've got to remember. One is it's taken this time around a tremendous amount of stimulus to get the sort of impact you got with much less. And that tells you the economy is less sensitive as it has evolved. But second, and I think much more important, and people don't realize this, is that these stimulus measures are inconsistent with where China wants to be over the medium term. Yes. Markets will feel it because the average S&P company is outwardly oriented. So it will feel it. The economy is very different. The economy is actually quite a closed economy. So we're going to feel it at the margin, but I don't think it does much to derail a strong consumer. And I think the strong consumer will continue to power this economy forward.
All right, so